Okay, got the recording going. Welcome aboard, everybody, for this Tuesday, week 8 for business finance. With the recording going, just remember to that the recording will be available for the world, and so by all means contribute, but don't contribute something which you might be embarrassed by if your grandmother finds it or something. Also, while I do invite you to have your cameras on, if you're a bit coy about having your image splashed across the internet, then I understand you remaining with that little bit of anonymity. I'm still waiting for the internet people to discover my face and have it done for some dastardly purpose, but I'm sure it'll happen one day. Okay, let's get ourselves started. I'll just move that around. Recording is going, and we'll share the screen. Screen 2, share, and we're in business. Okay. And until 3 o'clock now, we're going to be looking at business finance and, in particular, working capital. I'll go through the, do the same thing as we normally do. We'll be working through the PowerPoint slides. I'll take that out so I make the slides a little bit bigger. This session is being recorded. I'm just checking that the recording button is flashing at me. That's all good. Away we go. Okay, I'll look at the cost of capital. So far, we've been doing a lot of investigation, learning different calculations, calculation skills, which are all related to working out rates of return and the value of money into the future and all sorts of interesting, exciting things to do with financial calculations. What we're going to be doing today is using pretty much the same mathematics, and you've probably started to notice that we did some interesting and perhaps challenging things in the first couple of weeks of class, and then a fair bit of what we've been doing since then has really been applying those things in different ways. Okay, and so today is really no different. We're going to be looking a bit more at the character of the business, the firm, and how we work out the cost of capital. The last couple of weeks we've been looking at things like discount rates and expected rates of return, that sort of thing. And we've been taking a project focus more and more. Well, if we are looking for this expected rate of return, then working out the cost of capital for the company is an important part of solving that puzzle. Okay, let's move into it. I have to introduce you to an acronym, the Weighted Average Cost of Capital, the WACC. What's the weighted average cost of capital? That is our best estimate of how hard money has to work within the firm to be able to satisfy the basic requirements of keeping the company maintaining a steady pattern of share price. That's kind of, if you like, the background definition then. If the company makes a loss, obviously the share price and the wealth of the investors is going to fall. But even if the company is making a modest profit, that may not be good enough, because the investors, when they buy shares in the company, are expecting a certain level of profitability. We've been talking about hurdle rates. And the idea of this expected rate of return, if I'm going to buy a share in BHP, I'm going to be buying it because I believe that BHP is able to pay me a particular level of dividend, not just a dividend at all, but a particular level. So to a certain extent, the shareholders in any company have an expectation of what level of profit they're expecting. The more risky companies, say gold exploration or something, TABM, but let's stay with gold exploration. Because that's exploration, it's not certain, not like brewing beer and baking bread, you'd expect a higher rate of return because there's also these higher risk, higher chance of loss. And so for a gold exploration company to be, looking at new projects and what have you, they will have to have a different rate of return to, say, the Tip Top Bakery. And so that's going to affect every project that they take on. Okay, and we've been taking this project focus approach. So we're saying if Tip Top Bakeries is thinking of opening a new, type of bread, and maybe buying a new computer-operated, production facility, what have you, they will be looking at the performance of that new, we'll call it a project, that new part of their business, to be able to at least equal, if not exceed, the overall profit levels they need in order to pay off their various obligations. And the various obligations are mainly the bank with their fixed interest or their interest expectations, and also the shareholders with the shareholders' expectation of dividend. Now, this whole approach actually sort of twists around some ideas that's kind of worth giving some thought to right at the very outset. Normally when we introduce what a firm is for from a financial point of view, or even just from a corporate point of view, we talk in terms of the firm getting capital, funds, money, from different sources. And the nice thing about getting the money from a debt source is that you know the cost, and hopefully it's lower than the rate of profit you expect to make. So you're encouraged to borrow money to get your company going, okay? And you know what it is. On the other hand, if you sell shares, because the shareholders are simply going to earn all of the profits, or going to have distributed amongst them all of the profits from the company, you really can't say what the requirements of that source of capital is in terms of a rate of return. You know that the bank is expecting the interest rate as their rate of return, but how about the shareholders? Because the shareholders, by definition, supposedly, are only interested in just taking the dividend and getting the company to work as hard as possible to pay the highest dividends. So it's a bit of a mystery there. This is where we're going to be sort of turning this around, because we're actually going to be arguing that there is a cost of capital which is every bit as finite, as measurable as the interest rate the bank charges, even though the shareholders aren't going to be able to demand a particular rate of return. The bank says, I'm lending you this money on 5%. Well, you know that you've got a contractual obligation to pay 5%. No more, no less. But with the shareholders, you don't have that. They simply buy shares, take a bit of a punt, it's a bit of a wager. They're hoping that you might be giving them a 6% return, but it might be 2%, might be 10%, who knows? Right. So on one hand, the equities come without a guaranteed, a contractual obligation. On the other hand, the reality is that if you don't pay enough dividend to your shareholders, your ordinary shareholders, then on the stock exchange, people are going to start selling those shares because they'd prefer to invest in somewhere else. and your share price will fall, and that will hurt all of your remaining shareholders. On the other hand, if you do fabulously well and you produce more profit than everybody was expecting, people on the stock exchange are going to be clamoring to buy your shares. And so your existing shareholders are going to be very happy because they're going to be able to sell their excess shares for a lot more than they bought them for. And so they'll be earning their dividend, and they'll also be earning their capital growth because through your prudent management, the company that the share is a part of or relates to is actually becoming more valuable because it's working so well and all the rest of it. And so this, the tendency for shareholders to vote with their feet on the floor of the stock exchange and drive the prices either up or down means that there is this expectation, and the directors of the company, the CEO of the company, and everyone else in the company for that matter knows that they have to keep their shareholders happy. And so they first of all have to work out what level of return is going to keep the shareholders happy, and then they're going to devote themselves to actually realizing that. So if we put all that together, what we can see is that even the shareholders have an expected rate of return just as much as the bank does. And if that's the case, then what we're going to be able to do is add our various sources of debt. Maybe we might have mortgages, maybe we might have bank overdrafts, maybe we might have debentures, all combined together, all with different discount rates and different other circumstances perhaps. And we're able to combine those also with the shareholders on the assumption that the shareholders, we've got an estimate of what the shareholders expect. And so if we don't pay them that level of return, then that's going to be reflected in a falling or a rising share price. And we really want that sort of stability. Okay, so that's kind of the game. Let's go through the slides. Same as in previous weeks. What I'll get you to do is read through these in detail as you go through. And a lot of this I've already covered, or if not, then you can sort of read it in your own time. You'll notice here we're referring back to the capital asset pricing model, and I think you guys will start to see that CAPM is sort of relevant here because the CAPM is one of the ways that we, if you like, infer the expected rate of return for our equities, for our shares. Okay, read through all this stuff. As I say, it's all sort of fairly much background. We just notice, we'll come down here, very simple valuation equation. This is sort of the equation that we were using a few weeks ago to value shares, ordinary shares. So it's the dividend divided by the expected rate of return. And what we're going to do is just turn that equation around using a little bit of, just lower high school algebra, and see that same equation can be rearranged to actually make the rate of return the subject of the equation. So we can talk about the rate of return that's expected. And we're going to give that a slightly different title now. And by now you've probably noticed that in the finance world, it also happens in the property world, but in any of the investment kind of areas, you find that relatively simple ideas tend to have more than one name. And it's meant to be a trap for young players and maybe to sort of keep the uninitiated out of the game, even though it's relatively easy. Here, we've taken a simple equation, we've transformed it. It's not a very hard equation, something you can say very easy to get your head around. As well as that, we're going to say, well, this rate of return business, we're going to say, well, that's not something that we simply, kind of hope for or what have you. We're actually going to describe that as an obligation in a sense, because the managers of the company feel themselves obligated to maintain at least a stable pattern in the share price. And so rather than just a wish, this becomes an obligation. So we're going to reflect that by changing the name we're going to use here. We're not going to be talking about the required rate of return, R. We're going to talk about the cost of equity, the cost of ordinary shares. Okay, a number of these slides, I've simply changed the background color just to point out that these ones are the slides which I think require probably more attention. You don't need to do that when you download the slide pack, the PowerPoint file. You'll find that this sort of buff background isn't on there. Okay. So here we've simply taken the equation from the previous slide and we've rearranged it now, or rebadged it, to talk about the cost of shares, and we've simply put a couple of subscripts in there to be able to make that more apparent. Okay, so the cost of equity is the expected dividends divided by the price of the ordinary shares, and that gives us a very simple valuation equation. Okay, we can do a similar thing where we've got a growth situation, and growth in our world tends to be more common. And again, we're doing the same thing, taking the equation that we started off with, we're rearranging it so that the rate of return becomes a subject, and then we're simply going to replace R with K. K misspelt cost, K-O-S-T, I guess. Don't take the bad grammar or the bad spelling too seriously. It's simply so that the letter C is used for other things. Okay, there we have it. Transformed equation now expressed as a cost of ordinary shares. Okay. And we can rearrange the CAPM to also give us an expression which actually gives us the rate of return, the cost of ordinary shares, which is really coming out of this RM in the middle. I'm not going to do the transformation here. Those of you who are interested in mathematics and algebra and so on, I invite you to do it. It's not really that hard. Okay, so there we go. Now, again, a bit more background. We're going to be starting to look at the way the company is structured inside. We've been talking about projects for a while. Here, a project is some component within the company. It can be thought of as a subset of the company's balance sheet. And that's probably a useful way of looking at it. Tip Top Bakery is thinking of opening a new factory or maybe installing a new computerized machine or something. Big Tip Top company is the whole company. And I can use the capital asset pricing model perhaps to check that the rate of return for shares in Tip Top is whatever it's going to be. That's fine. Does that help me to estimate how hard the capital I apply to this new factory or this new computer-operated bread baking machine goes? Well, the answer is no, not quite that easy. What we want to do is find out exactly what the complications are. Okay, let you read through this. I want to get down to this slide, slide 16 in the slide set, if you have it open there. In fact, I might grow this a bit. What I want to do, remember last week we put up an image that was sort of like a stylized balance sheet. Was it a balance sheet last week? Can't remember. But here I want to look at the balance sheet and understanding the geography of the balance sheet. And in particular, I want us to look at this section on the right-hand side here. The right-hand side of the balance sheet is where the firm, the company, gets its money from. And in this particular example, there are creditors to the company. These are individuals or companies to whom the company owes money and will probably repay it maybe in a few weeks' time. A month is usually the maximum, but those obligations are going to be rolling over constantly. And so we consider that as even though it's working capital, it's a current liability, because it's a relatively stable amount, month by month it tends to remain the same, then it's considered to be one of the components, if you like, in the capital structure of the firm. Okay, that's the current liabilities. We're going to add to that long-term debt. These will be debts which are going to go typically for more than 12 months. So mortgages are a good example of that. All of those we're able to put a rate of return on, an interest rate usually. And so if we've got debentures, notes payable, that's certain value. They would have been sold with an expectation of a rate of return built into them. Accounts payable and accruals tend to come interest-free, so they're a pretty attractive source of capital. But then long-term debt, mortgages on the company's real estate, they're very stable in that you expect the company to be sustaining that debt over a long time, perhaps not even paying it down. If you borrow money to buy yourself a house, you're expecting to be paying that off over the next 25, 30 years with interest and principal combined in your monthly payments. A company, on the other hand, it might have a mortgage as well, but it might strategically choose not to pay any principal back. So they might have $10 million piece of real estate and they will borrow on that. But instead of making payments that represent principal and interest, they might be content merely to pay off the interest part. It's called an interest-only loan. And that is potentially a very long-term debt because it could be as long as the company exists. So that's this second area. Combined, you've got the current liabilities. They tend to be liabilities that are going to be coming and going over the year, even if they're durable. So the company is always probably going to be having somewhere in the vicinity of $150,000, $160,000, or whether these are in millions, whatever they are. They're expecting to have this amount on the books at any one time on average, because that's simply the way that the accounting system works and the offering of credit. These fellows are going to roll over if, depending on how long they are, and so on. So that's your debt. Then we come down to the equity. Equity is made up of, it can be made up of a number of components. Here we've got a very simple situation. We've simply got ordinary shares and those past profits that haven't been distributed to owners yet. And so we refer to that as retained earnings. And retained earnings is a very important part of what supports the company in terms of capital. The reason is that often instead of borrowing money to, say, expand the company, it's considered most appropriate simply not to pay the dividends. From the point of view of the shareholder, returned earnings left in the company should be translated into higher share prices. Okay. Why am I going through this in detail? Because you can't overdo your understanding of what I call the geography of your balance sheet, and sort of seeing it as something which is, got several components. Each one of them works differently from a financial point of view. Is important to get your head around. Okay. Come back. Okay, a little bit more to read here. And these are things which you would have done in your accounting. The balance sheet is normally considered to be the answer, the result of all of your bookkeeping, your accounting process. And there are often differences between the balance sheet values and the actual market values of its various components. I'll let you read through the remainder of that. One of the things I'd like to get you to think about, and I'll come back to this diagram here. Where is it? Here. This fellow. So when we look at this side of the balance sheet, the capital structure of the balance sheet, the structure that gives us the origins of all of our capital, we can see that some of these come at higher risks and higher returns, like the ordinary shares tend to have that character. Some of them come from lower risks and lower returns, and some of them, especially the accounts payable, actually comes with no cost of capital at all, because typically the accounts payable, which represents the unpaid bills of the company on its working capital, so a shop, for instance, will buy a certain amount of stock. They might have 30 days to pay for that stock, but during that time, the company, let's say it's a supermarket, is expecting to actually sell the stock and buy some more. And that means it's nice from the company's point of view, the supermarket's point of view, because if they're able to sell the stock before they've actually paid for it, well, that reduces considerably the amount of money they need to have tied up in their company. On the other hand, the supplier is happy to wait for the 30 days because that ensures them a happy customer and repeat business and a whole lot of other good things. And so they don't charge interest for that because they rather see it as a service that they provide for the purpose of keeping the risks of losing customer down. Okay. However you look at it, the capital structure side of the balance sheet consists of some things which are low returns and low risks. Hopefully creditors think that you're a good risk. They range through the medium risk and return, and then there's the long-term risk and return. They're all different. In a sense, the capital structure side of a balance sheet looks a bit like a CAPM model or even a portfolio all wrapped together. You've got, we'll use the metaphor of a portfolio. What we've really got is a portfolio of creditors, a portfolio of different risks and returns for the different parts of the capital that the company is working for on. The company has it has to have however much money it is, 100 million, 10 billion, whatever it is, and each slice of its sources of capital has its own risk and return character. Why am I stressing this? Well, partly to get you to see the balance sheet as something to manage and to really understand, but also leads on to applying the same sort of thinking to the asset side. Here we have the assets. Typically, the assets are split into current assets or working capital assets and capital assets. So we've got working assets, current assets, cash in the till, marketable securities, so things you can just go out and liquidate, sell, and you end up with a return, let's say in 24 hours. Accounts receivable, all part of your working capital, and because an account receivable is where you've sold something on credit, and you're just waiting to the end of the month when your debtor, person you sold it to, is going to pay you back. And the third area of current assets is your stock, your inventory. Curious thing about these is that most of them don't have an interest bill or interest earnings. Marketable securities is probably the only one that do. Okay, cash, you don't get an interest rate or an interest return simply by having cash in the till. You've got to do something else with it. Accounts receivable, people have bought things from you on 30 days credit or whatever they are, and so you're not going to be charging them because you like having their business, and so not going to be any rate of return on that. Inventories, likewise, stock on the shelf. Well, it's just sitting there getting dusty, isn't it? It doesn't have any cost or revenue associated with it in itself. Okay, that's the current assets. Okay, apologies for that. What are we up to? Oh, we're looking at the assets. We're dividing the assets between the working capital assets, the current assets, which is these different classes, and the capital assets, which are, if you like, the permanent assets, the ones below the line here. They are all meant to return some kind of benefit to the company. They represent, if you like, built-in risks and different expectations of return. So if we have, for instance, real estate in our balance sheet or on our balance sheet, that might be considered as lower risk than maybe our inventory, our stock on our shelves, or even our accounts receivable. And so the property might implicitly come with lower risk and a lower expectation of return. Whereas the money that you've got tied up in inventory, accounts receivable, and so on, that might be perceived as the hard-working capital. And so you expect that to turn a greater level of profit. And because it's turning a greater level of profit, but you really don't know whether you're going to sell something off your shelf or not, it's going to be a lot more risky. You know, the real estate's going to be there regardless, whereas the performance of your inventories, either things, you know, because maybe the sales don't happen, or you end up with some sort of spoilage or shrinkage or what have you. Your inventory is quite risky, but it's potentially profitable, whereas your real estate is just about the opposite. So we can sort of see here that, in a sense, the balance sheet is like this whole maze, a portfolio of risk and return in both receipts and costs. Okay? And so that makes it in itself a fabulous thing. From a theoretical point of view, what that means is that if I know how much profit I need to turn on each one of my 1.177 million, or maybe these are denominated in thousands of dollars, whatever it is. Now my 1.177, whatever it is, millions. Okay, I know from here how hard my capital has to work, and therefore from here, when I look at these, I might say, well, I'm never going to get very much to come out of my property and plant and machinery. That's low return and low risk, but I'm going to expect more to come out of there. That's, if you like, the perfect picture. If I had perfect information, that's the way I would balance it. In practice, though, you tend not to have that level of understanding of the risks and return of the various parts of your company. Now let's read on. Read through this slide. Okay. And coming down again, this is a slide that I've recolored the background to make it a little bit more obvious that it's significant. It's slide number 18 if you're going through these slides yourself. Okay, what we have here is really a stylized balance sheet. We've been looking in the last diagram on the numbers on it, on the capital side of the balance sheet, and here in the blue we've got the assets side of the balance sheet. We can split this further because the liabilities can be considered as long-term liabilities versus current liabilities or short-term liabilities, depending on what terminology you want to use. Here the assets are going to be split mainly between the short-term assets, things like your inventory, accounts receivable and so on, and the long-term assets, the fixed assets, the capital assets, which will be mainly property, plant and equipment. And there are a couple of other segregations that you can use. This as a conceptual tool I find really, really useful, because now you're starting to see the balance sheet not as simply some result, some static thing, but rather something that you can actively manage and strategically manage. We're going to see how that actually pans out. Okay, I'll bring the zoom in a bit. Here's an example. I'll read through this one. We won't necessarily do the calculations. A firm's balance sheet for the most recent year lists 12 million and 10.3 as the value of its long-term debt and preferred stock respectively. Assume that all debts have been raised through the firm's 10-year 0% coupon bonds. The bond has a face value of $1,000 and 9 years till maturity, and the interest is compounded annually. The preference share pays $6.50 dividend yearly. The number of bonds and preference shares outstanding are respectively 12,000 and 80,000. The bonds and preference shares are currently selling in the market respectively for $820 and $70 per unit. What are the market values of the firm's debt and preferred stock? You notice here that we're rolling together preference shares and debt. Remember when we were talking about capital structure a little while back, we noted that preference shares tend to have pretty much the character of debt. And here it's kind of coming in again. Main difference is that the interest cost for debt is tax deductible, whereas the cost of paying the dividends to the preference shares, because it's technically equity, is not tax deductible. Okay. So here we've got the number of bonds outstanding and so on. So we can say we've got $9.84 million worth of bonds, and we've got preference shares. We've got the number outstanding times their value, which is 6.5 mil. Come along. Estimating the overall cost of capital, we can read through that. What we can say is that, coming back here, we've got our $9.84 million. We can also look at the return that those bonds are paying, or understood to be paying, and that will give us a cost of capital for our bonds. We do a similar thing with our preference shares. I'll let you read through that. I want you to get down to this fellow down here. And here we're really applying something like a CAP-M, or it is a CAP-M, to the puzzle. We're using the capital asset pricing model to work out the cost for the project. And if we understand the risks and returns and are able to differentiate the different levels of risk for the different parts of the company, then we're able to do this type of calculation. However, there's a problem. And that is that this approach only works if we understand the betas involved. Let's look at the reality. The reality is that you really can't work out betas within the company. And so here we say if the analysts at a company could estimate the betas for each of the company's individual projects, right? That's a big if. And notionally that should be possible, but it probably points out some of the complications, the problems that are inherent in the notion of betas at all. Remember when we were talking about the capital asset pricing model, I mentioned that while the betas are worked out from the relative variance of particular investments compared to the performance of the All Ordinaries, you can't really do that for the individual projects within the company. Okay. And so this whole approach, while it's notionally the right approach, is difficult in practice. So generally we can't use this approach. We take a different approach, not necessarily an ideal approach, but it kind of gets us kind of close to where we need to be. Okay. As long as we can estimate the cost of each type of financing, and we can estimate those from the tools that we've introduced over the past few weeks, we can then roll them up to estimate the weighted cost, if you like, of capital for the entire company. And that's very much what this equation is meant to convey. So the cost of capital for the company is equal simply to the sum of the individual costs times the individual volumes of each dollar or each class of dollars that make up your capital structure. Looks like a pretty scary equation there, especially when you put sigmas and fancy subscripts and so on in. But when you look at the right-hand side here, it is nothing more than a weighted mean or a weighted sum. Here is a simplified version of that. If we only had one source of debt and one source of equity, then the cost of the company would relate to the cost of debt times the amount of debt. And likewise here, it will be the cost of equity. So the rate of paying a dividend to each share that would enable the share to maintain a stable pattern of share prices. If the dividend was too high, the share price would go up. If it went too low, it would fall. Okay, it comes down to this equation here. So become familiar with this one. It's actually conceptually quite easy, but it's just an unfamiliar way of presenting it. Okay. If the financial markets are reasonably efficient, then what we should find is that every part of the company's balance sheet should be adequately priced, and the overall value of the company should already have been factored in by all of these shrewd investors who have done rational things. That's kind of nice in theory. The difficulty is that financial markets, the meaning of efficiency is pretty questionable. Okay, let's look at customized or the cost of debt. The proxy that we're going to use, the alternative, the stand-in for doing this, is simply, instead of saying, well, we can't work out the cost and beta of every component in a company's capital structure, what we're going to do is simply work out the overall average. And then a simple approach then is to say any capital asset that we're thinking of acquiring, what we'll do is subject it to the test that has to be above this cost of capital. and that makes the whole project kind of easier. Okay, how do we do that? Well, we work out the weighted average cost of the capital, which is the right-hand side of the balance sheet, and we simply apply it to every asset on the left hand. It means it's not quite as nuanced as taking into account the risk and return, but it does give us a decision tool. It has resulted, oddly enough, in a lot of companies getting rid of some of their most durable capital assets, especially real estate. So, for instance, most banks now don't operate in their own building. The building might still have Commonwealth Bank written out the front of it, but the building's not owned by the Commonwealth Bank. It is merely renting that building, and so that's an example, if you like, of managing the way that capital is actually utilised without necessarily buying it. Okay, let's look at the cost of debt. Cost of debt is really a matter of going through the various parts of the debt and doing what is basically a weighted mean. And here we're going to, well, the main thing is that we're working out the average cost of debt. I'm going to do that by first of all working out the effective annual interest rate, because things like bonds and so on, which are typically operating on a semi-annual basis, compounding period, and even like mortgage and so on, that can be on a monthly compounding. We want to return those to an annual amount. Simply gives us a single, like a standard measure to use that we can then combine. And then we'll adjust it for tax. This equation is worth being familiar with. It's not at all difficult, because we're simply looking at the cost of interest pre-tax, cost of debt after tax, because pre-tax debt is a tax deduction. And so we simply take the, let's say this is 6%, and if, let's say, the tax rate is 40 cents in the dollar, 0.4, we take our 6%, we multiply it by 1 minus, what we say, 40%, so that's about 0.6. So it becomes 0.6 times 6%, and so 0.6 of 60 is 1/6 of 60. 1/6 of 60 is 5. Mental arithmetic leaves me for the moment. 40%, 6%. So we're taking whatever the numbers are. Okay, we'll do an example. You have just calculated the yields to maturity be 14% on a bond, which pays coupons semi-annually. What is the equivalent annual return to an investor for purchasing a bond? What is the after-tax cost of debt, assuming a tax rate is 30%? Let's do that on our spreadsheet, and I invite you to do this also on your financial calculator. We'll just get our Zoom sheet, or sorry, our Excel sheet up here. Give ourselves our slide. We're going to say the yield to maturity, 14%. Tax rate is 30%. hang on, missed a step. In our example, we've got equals to, okay, we're going to be applying the effective annual rate equation. So now, well, okay, that's all written out for you. You can see that. I'll just go straight up and put our answer in. We'll use 8.49%. The equation I really want to model here is the after-tax calculation. So here we're going to have cost of debt. It's going to equal 14% times the tax rate. Put that into percentage. And we can see we've got the 10.143. You can see at the bottom of the screen. And here in the slide, we've calculated 10.143. So a simple calculation. Here we have further examples, and pretty much the same thing. We're going to be looking at taking our basically estimating the effective annual return. Here, if you work through the maths, and I invite you to do this in your own time, you get an annual effective return of 2.23%, and before tax is 2.23. We multiply it again by 1 minus the tax rate, and so that brings it down to 1.61. Okay. You can apply that to each one of your sources of debt. The only one that you don't really need to apply it to is your accounts receivable, and the reason is your accounts receivable don't have any interest charge attached to them. Sorry, accounts payable. Accounts payable doesn't have an interest rate attached to it under normal circumstances. Okay. What this is telling us here is that what we're going to be doing is basically just taking each one of our different bits of debt individually and doing that same relatively simple calculation. Do whatever it takes. You may have to adjust the term and the recurrence interval, the number of compounding periods in a year. You simply adjust it down to annual rates, and then you adjust it for tax. And if you have that for each one of your sources of debt, then you're able to do a weighted average to get an overall weighted average cost of debt. Okay. Now you come on to doing the same thing for equity. Now I'm just noticing we're coming up for our hour now, and in the last few weeks I've been running you fairly late. If I go on to this topic now, this will take us a bit of time. So what we might do, we might take our break now. We'll take a 10-minute break, and so I'll let you just go off and grab a coffee. I'll stop the recording, stop the sharing. Okay, we should be back again, and also we should be sharing the screen. So you should be seeing the cost of equity ordinary shares as the slide which is up in front of you. Pretty sure that's what should be happening. Let me know if that is not. And away we go. Okay, I've got the recording going again. So that should have everything running along happily. Okay, before the break, we looked at the way that weighted average cost of capital is the estimation, the calculation of the overall cost or return. No, it's the overall rate of return for the capital structure of the firm, which is made up of debt and equity. And we've said that that calculation is going to be a weighted average cost. Okay, we've dealt with debt, and now we're going to be looking at the cost of equity. One of the things that you may have noticed, and we went over it probably fairly briefly or quickly, was the way that debt has to be adjusted for the effect of taxation. So don't forget that. In fact, we'll just go back, and if we can find that simply, it might be this one. Okay, that's very important. Okay, this is really important. The interest cost is a tax deduction. And so the fact that it might cost us, let's say, 10% to borrow money, let's say on a debenture or something, if we're able to claim back 40 cents in every dollar that we spend in interest, it really means that 10%, by the time we get 40% back, is really only costing us 6%, 1 minus 40%. And so 10% debt really only hurts to the extent of 6%. Okay, fairly important. And that's going to be particularly relevant when we look at equity, because any sort of equity doesn't have that built-in tax deduction aspect. That really makes calculating equity that much easier. You've got one less step. The hard part is this conceptual idea of seeing equity coming at a knowable, finite cost, when in fact most of our introductory descriptions of how firms work and when you've done bookkeeping, how equity works, all suggest that equity does not have an explicit cost. It really does. Okay, that's the hard thing, or the thing to get your head around for what we're up to at the moment. Okay, when we look at equity, we see that equity isn't simply one box. There are ordinary shares, we've already gone over this. There are preference shares, there are other creatures called deferred shares, and almost any form of share that you can think up in terms of splitting out whether the shares participate in all the dividends or the decision making, or they're permanent, like eternal, or whether they're things which the company is eventually going to buy back. All that all gives a complexity to the equity part of the equation. And one part that needs to be remembered also, and we're probably going to be seeing this as we move along, is the value of retained earnings. Retained earnings are those dividends which aren't distributed off to the shareholders. When you first encounter retained earnings as a concept, as let's say doing bookkeeping as an accountant, you think, well, that seems to be a bit of a waste. Here are all these shareholders expecting to get a dividend, and you're not giving it to them, you're keeping those retained earnings. Why do this dodgy thing? Retained earnings can be a fairly substantial part of the balance sheet, because they're often used as the most effective form of capital raising. It's easier to simply not pay out dividends than it is to sell more shares. And notionally, because the retained earnings increase the overall value of the balance sheet, value of the company, notionally, if there's, let's say, 10% of the dividend which is retained rather than distributed, and if that's going on, an ongoing basis, what it means is that each share, let's say it starts off at, the shares are worth $100 each or something, if 10% of the earnings is being held back, instead of that affecting the value of the share, the the value of owning the share in direct income terms, that retained earnings then implicitly adds to the value of the share. So if you don't pay the 10% of dividends, then that share will probably go from worth $100 to the point where it'll move up to being worth $110 because there's actually value in the company that you as a shareholder own a part of. Okay, we'll look at that separately later on. Overall, the cost of equity for the company is a weighted average cost of the different types of shares. That should be fairly straightforward. So this is not hard, just a weighted average. Now look at ordinary shares first of all. And there are a number of ways of valuing ordinary shares depending on the circumstances and what kind of data you have, and to a certain extent the situation of the company. So let's look at what the possibilities are. The three alternative methods: using a capital asset pricing model. Well, it's kind of handy that we've gone to all the trouble of learning the capital asset pricing model. Now we're going to put it to work. Alternatively, you can use one of the equations or the methods that we've used for directly calculating the cost of ordinary shares, working as capitalizing the dividends in a growth or even in a supernormal growth environment. So there are three possibilities. CAPM, capitalization assuming constant growth, which is normal now, it's just a variation of a capitalization approach, and a capitalization, well, an estimation working on a more complex pattern of growth. Now this is, you've seen this before. Okay, we've done CAPM 1 week. We've looked at valuation of shares using constant growth, and we've also done the slightly messier form, which is the multi-stage one, which most of you will probably remember, with all sorts of sleepless nights from that very last question in the recent assignment. Okay, let's look at the capital asset pricing model. This is what should be becoming very familiar to you, the equation for the CAPM expected rate of return for a particular share, made up of the risk-free rate plus the beta of the particular investment multiplied by that gap, that increment between the risk-free rate and the market rate. Okay. We can simply rearrange that, and wherever we've got an R, we can think of it in terms of a cost. So read through the notes there, especially in terms of what the different terms mean. If you're doing this in practice, you can use all sorts of complicated methods to work out the beta. And here it's suggesting using regression analysis. We're not going to be going into that particular tool. It's simply a matter of using the statistics tool, regression, to estimate the beta, basically get a best estimate from it. It's where the theory of the CAPM, I think, runs aground with the realities, and also the kind of data which is available, and also that ugly question of whether beta really is risk and whether the variance of past returns is actually a good estimate of the current riskiness going off into the future. Okay, one handy thing to do, well, an easy way to do, is by finding a comparable company. And that's always one of the delights. Part of the theory of the capital asset pricing model is that similar markets perform similarly in terms of their risk and return profiles. Indonesia or Japan may have different overall characteristics compared to Australia, but someone baking bread in Australia is going to have a similar situation to somebody baking bread in, let's say, the United States or some other comparable market. Also, if you're thinking of starting, let's say, a new boutique brewing company, and you want to get an idea of the betas and performance and all the rest of it, what you can do is say, well, I know some established companies which are currently trading on the stock exchange. How are their betas going? Because beer brewers tend to live in a particular part of the capital asset pricing model. And so I can use the comparable company or comparable markets, either of them, to work out or to observe betas from other places that I have reason to be confidently believe they're going to operate in the area that I'm looking at. Okay. You read through those. Yep. That's fairly straightforward, I think. Here we have a fairly simple example. And really simply the application of the capital asset pricing model. I don't think we really need to do that by hand. The capital asset pricing model is pretty straightforward. We've got the market risk premium is, the risk-free rate and the market risk premium, 5.5% and 3.5% respectively. We're looking at a beta of 0.86, so we've got all that given. So all we have to do is go through and evaluate the equation. Too easy. Okay, let's move on to the constant growth model. This is probably the most common. It has the advantage that the data for it is usually fairly accessible, certainly the critical data. It's less complicated than the CAPM, and it's got better data. So for a constant growth dividend model, we simply take the equation that we found earlier on. We're going to rearrange it simply by doing a bit of algebra, and I'll let you do this in your own time. It's a little bit of fun with a piece of paper and a pencil. We're going to turn R into K. We're going to make that the subject. And so if you just multiply both sides by R minus G, divide both sides by PO, and then eventually, it's interesting. Multiply both sides by R minus G. We're going to divide both sides by PO. We're going to add, I might have to check that. Oh,
Professor, when I calculate it, is the plus G.
Should be a plus, shouldn't it?
Yes.
I'll agree with that. I think that slide is actually incorrect, just looking at it. Yeah, that should be plus G. So my apologies for that. I don't know if I can actually change this slide on the run, but what I will do on the run, where's my design page, format the background. I am going to put that in a solid fill. And I'm going to make it a red background, right? I'll fix that for you and see if I can get it onto the onto Moodle for you. But just notice that should be plus G. Yeah. No, thanks, Yoki. Okay. Well, okay. Let's carry on. Okay, read through. You notice that here we're using the correct equation, okay? And we've got a worked example, and I think all of the data is there. The price is 20, D is 2, G is 3, and that's so straightforward. I think if I put it up onto a Excel spreadsheet, I won't be telling you anything more that you don't see on the example there. I think we do this pretty much mentally, can't we? Dividend of $2 over a price of 20, so that's going to be 0.1, 1/10. 1/10 plus 3%. Okay, 1/10 is 10%. G is 3, so it becomes 0.1 or 10% plus 3% or 0.03 equals 13%. So that's a nice mental one. Okay, the other important thing on this slide is that the after-tax cost of equity is equal to the before-tax cost of equity, and the reason is that you don't have that effect of tax deductibility, sort of complicating the issue. Right, so if that's costing us 13%, it's costing us 13%. Remember, when we're looking at debt, if we had debt costing us 10%, we're able to claim 40% of that 10% back as a tax deduction, and so the 10% debt becomes 6% debt. Here, 13% cost of equity is still 13%. Now you can see there's a disincentive for the company to raise capital using equity, right? Because there's a naturally bias. The tax deductibility tends to put this bias towards debt into the way the company kind of thinks, because it's going to have to work harder if it raises equity, let's say on a 10% expected rate of return, and it's got debt on a 10% rate of return, cost, whatever you want to call it. If it's all equity, then that's a 10% hurdle it's got every project has to get over. If it's only funded by debt, then it's only a 6% hurdle. So you don't have to have your projects working nearly as hard for you if you're debt funded, and that becomes quite a temptation for the executives in a company when they're looking at how to expand their company, because of this fact here in red. Okay, now we get to the multi-stage, or what we previously encountered as the supernormal growth model, okay, which is pretty much what's being described there. The interesting part, I think, is this table here, or this timeline. Remember, I think last week I was looking at getting you to do cash flow diagrams. I showed you one form of cash flow diagram just to give you an idea of how they work. So saying timeline, I like to draw them with the up arrows and the down arrows. It conceptually calibrates for me whether there's cash going into your pocket or out of your pocket. Here we've got the same thing, only we're just talking about numbers and algebra here. But basically each one of these dividends is able to be discounted back to the present. So this is the supernormal growth phase of the company. A bit like the assignment, isn't it? Here we've got a situation where we've got a dividend which then kind of grows in a nice, orderly, stable growth kind of model. So what we're able to do then is calculate all of those dividends and give them a present value back to this point in time, beginning at there, because those dividends all then are evaluated back to T0, which effectively is this point here. Right? And you will notice as we come down, even though we're using the constant growth model to work out the values of the security at this point, notice here the superscript, the power. I'll just magnify that to make it a bit obvious. You should be able to even read through Zoom there, that the discount factor here is 1 over the cost of ordinary shares cubed. And so we've got 1 over the cost of ordinary shares, that discounting the first cash flow, 1 over the cost of shares squared, discounting the second one, 1 over the cost of ordinary shares cubed here for the third one. But when we get up to this sort of fourth and consequent, we're actually discounting it by the third year. And that's because using this equation brings the price back to there, one time period before the first regular dividend. I find that kind of awkward to kind of get your head around. In fact, just about every time I come back to this after a bit of a break, I have to remind myself of it. And so I expect that you guys will probably have the same little bit of an intellectual challenge, especially when it's getting close to the exam and stuff. Okay, but just be very, very clear with that. Here, the all of those things are all just reduced to one slightly more conventional but very ugly looking equation. And again, you can see that the discount factor here is the cube, right? Okay, that's the way you do that, and just running it for particular examples. If you've got through question, was it 5.3, I think, 5.2 or 5.3, then you've already done that in practice. Okay, which method should we use? Well, basically the method you use depends on the data you've got and the quality of the data you've got. CAPM is useful if you've got a nice, well-behaved public listed company, so that's all good. If you don't, then you can use those other models, especially when you're not sure where on the CAPM it operates. So especially, say, for younger companies, so in a period where they're in that supernormal growth phase, you may not have enough data in the available to be able to do the CAPM calculations, which you won't be able to calculate the beta. Okay, come down, we'll look at, we've just done ordinary shares, so now we'll look at doing a similar thing for preference shares. Okay. Preference shares are different to ordinary shares because their rate of return is specified within the terms of the preference share. Not quite as simple as what's on these slides, because there are different types of preference shares. We can have preference shares that participate in dividend rates which are above the nominal rate or above some specified threshold in the preference share definition. But here we'll just look at a simple case where the preference share is written with a specified dividend and therefore also have a specified price, and could be easier simply capitalizing the dividend that we should know for sure, because it is a preference share, it does get paid the preferential dividends, divided by its price. So, as I say, can't be easier. Worked example, I'll get you to work through that in your own time, and it's a good opportunity for you to practice with your financial calculators or your ordinary calculators or your Excel. So definitely work through the examples, but not very challenging. Now, what that means is we've gone through the different sources of debt, the different types of ordinary shares, or different circumstances of ordinary shares, and we've looked at preference shares. I should have probably mentioned when I'm talking about preference shares, the way that preference shares on one hand appear to be like debt in that their dividend rate is known, and often, usually, preference shares tend to be terminating. So again, they're very similar to, let's say, a terminating loan of some sort. But the big difference is that you don't get to discount, if you like to use that term, or reduce or whatever. You don't get to adjust the cost of preference shares by the 1 minus T factor, and that can be quite substantial. Okay, let's look at the calculation of WACC itself. we're going to be doing is basically taking the cost of debt times the amount of debt, all adjusted by the 1 minus t factor. You're going to be adding to that the cost of shares, whether they're ordinary shares or regular shares. And so it's just basically an agglomeration, a weighted average. Okay. We go through these examples, and this is pretty much what the rest of the slides are going to be doing. Now these slides, going through the worked examples on here, I think you can do those probably about as well as I'll be able to talk you through them or demonstrate them. The mathematics is quite straightforward. In this particular example, we've simply got all of the data laid out fairly transparently. It's simply a matter of working those through, just the simple divisions. Okay. On shares, let you work through that. Then we get to the actual calculation. And that will be in terms of the amounts. It's a weighted average, and so we're going to be adjusting that back by the actual total volume of capital we have available. Similar thing in the second example. And you read through that, Okay, yeah, run through that in your own time. Let's go through some of the issues. I'll get you to read through these. They're, I think what's written there, it'll read about as interesting to you as it does having me just read it out to you. So I don't think we need to do that. If you have any questions, let me know and ask me either this afternoon or tomorrow as you read through. I'll be very happy to talk more about them. Okay. Okay, taking account of the semi-annual nature of it. Let's work examples. We can do those. Okay, and so work through those. The nice thing here is that giving you equations, and it's simply a matter of applying the equation. So it's kind of good practice for you. It's probably actually better if you do these calculations yourself rather than simply watch me press the buttons. Because if I just press the buttons in front of you, you guys will just be falling asleep and probably thinking about grabbing another coffee. Whereas if you're actually doing it yourself, you're actually seeing this stuff kind of, you know, emerge kind of out of the massive numbers that you're playing with. So by all means do this. The fact that I'm not doing it in class doesn't mean that I don't want you guys to do it. It's just far more important than for you guys to do it and actually sort of see it in yourself. Okay. I'd like to now move on to some of the practical aspects of using the weighted average cost of capital. A lot of people, after they've discovered what the weighted average cost of capital is, they think, oh, that's it. The question discount rate is now solved. Whenever I want a discount rate, all I have to do is work out the WACC, the weighted average cost of capital, and then I'll apply that to my particular problem, and bingo, got it done. So the discount rate becomes, you know, sort of easily soluble. I mentioned right at the outset, and we're really sort of coming back to this, that within the company, you can think of the company as like a portfolio. And it's a portfolio of different components that some are going to be high risk, high return, some are going to be low risk, low return. And so they have this kind of character of being very much like a portfolio. When we're looking at the weighted average, the CAPM, and also the portfolio theory, one of the things that we made a big point of working through was the way that when we're considering possible investments with different risks, we're expecting different returns, and so we have to adjust out the risk issue. Here, that's actually fallen through the cracks. What happens is that the tendency is to say, okay, then I'm tip-top, I'm thinking of putting in a new factory or a new computerized self-cooking production line, whatever, okay? And you simply apply, you work out your weighted average cost of capital, and then you apply that WACC to test whether your new line is going to perform or not. Okay, what happens there? Well, the downside there is this. If it turns out that the thing you're applying it to is of its nature a part of your balance sheet which is risky and therefore deserves a higher return, then when you say, okay, I've got a 7% return as my weighted average cost of capital, and some hotshot salesman comes along and wants to sell you a new production line, and he gives you a whole lot of numbers, and one of them is that this production line is going to produce an 8% return for you. There's a tendency to say, oh, good, this new production line is going to return 8, my weighted average cost of capital is 7, and therefore the fact of this new, if I employ this new production line, this new project, every dollar that I put into that is working harder for me than my capital needs to work in order to satisfy the needs of my creditors and my shareholders. So I'll buy it. True, too easy. That's the tendency with using weighted average cost of capital as the decision criteria for projects within a firm. If you look a little bit more closely, you might find that starting a new plant or a new machine or whatever it is actually a very risky venture. Do we have the market share or the potential to grow our market share or demand for our product so that this new machine with its hotshot, extra production capacities and all the rest of it, do we have enough work to keep this thing adequately employed to pay itself off? Now, that's a practical question that means you'll have to go and talk to your marketing people and just look at the market and demand and all those sort of things. And if the answer comes back and says, well, actually, even though the project will exceed our WACC, our weighted average cost of capital, the fact is that we've estimated it to be, let's say, 9%, and we say 8%, and the WACC was 7 or 6 or something. Then the fact of the 8 hasn't taken into account risk, and therefore it might be a bad deal. On the other hand, if another opportunity comes up, and maybe you're thinking of moving the head office of your company from rented premises somewhere to a different location where you can own all your real estate, and you don't have a rental risk, and who knows what other advantages you have. And you look at that and you say, oh, well, okay, then real estate currently is returning a return. This particular piece of real estate, especially when I've analysed it, I'm going to expect about a 4.5% return on that real estate asset. And then some hotshot finance officer comes along and says, oh, you can't do that. Weighted average cost of capital for this company is 6%. And you're thinking about buying a block of land or a bit of real estate that's only going to return 4.5%. No do. Right? What's going on there? Well, the problem is that the real estate acquisition, which might be a very fine and prudent thing to do, is within the balance sheet lower risk than your average. in many ways, if you're buying a new property for your head office, the demand for that space is going to be relatively constant. It's not going to change with the wind in the same way that your sales are. So it's lower risk. Therefore, with the CAPM kind of thinking, you'd say you can tolerate a lower rate of return on it. You see, that's invisible when you're simply saying the new project, in this case real estate, is meant to return a 6% to meet the WACC, but it's only measuring 4.5% because it's real estate. You've forgotten the fact that the real estate is very, very low risk, especially if you go in without debt. So even if you might buy that and your bread baking sort of performance goes down, you're still not going to lose because you can still sell that property conceivably back to someone else and make a profit. Okay, that's pretty much what's explained here. That's a pretty important limitation because a lot of people are tempted very often to use the weighted average cost of capital as the discount rate for individual projects, when in fact you're not really able to do that, at least not able to do it sort of prudently. This is illustrated, hang on, I'll just go through. Yeah, it's just more of the same. It's illustrated in this graph. Now this kind of puts those two options that I've been talking about into the context, if you like, of a CAPM kind of model. Just look at this far. Okay. And what this is meant to do, it's meant to be an illustrative CAPM line, and there are circumstances where conceivably your conservative estimation, while if it's adjusted by risk, should come down to the point where it becomes attractive. And likewise up here, because of the profile, if you like, of the industry that's involved in this, you're going to be rejecting, you're going to be accepting the projects with high risk, maybe accepting the new production line for a tip top or something, even though it appears that it's giving a good return. On the other hand, buying the new head office building or what have you, you might reject that because the company is saying, well, this is not simply meeting our hurdle rate, our weighted average cost of capital. So you can end up with two errors kind of coming from relying too much on the weighted average cost of capital. Okay, this is being distilled down into a couple of conditions. The first condition is a company's weighted average cost of capital should be used to evaluate the cash flows for a new project only if the systematic risk for that project is the same as that for the portfolio of projects that currently comprise the company. So if we look at the portfolio of projects, or in fact the portfolio of capital assets, and they're all being designed to be more or less fit in the same kind of ballpark, the levels of systematic risk, which is really what animates the capital asset pricing model, then using WACC is useful because in a sense there's a homogeneity, a homogeneous kind of character between the different investment possibilities. Okay, condition 2, a company's weighted average cost of capital should be used to evaluate a project only if that project uses the same financial mix, the same proportion of debt, preference shares, and ordinary shares. Okay. What this is really saying is that use of WACC only really is applicable to projects that derive their financial character, if you like, in the same way with the same risk profile as comparable projects, and in fact even your source of security. That's, yeah, give a bit of thought to that, and it should become very obvious why that's the case. Okay. It's just really telling us that using a public listed company as a proxy. So again, if you've got Tip Top Bakeries listed on the stock exchange, and you're thinking about doing some little baker shop, something you think is in the same industry, then you can use the performance of the comparable instead of the weighted average cost of capital for your own. You can certainly use comparables as a way of calibrating, of checking, of verifying that your estimate worked out by WACC is reasonable. Okay, got the formula, practical aspects. I think that speaks for itself. That's really the capital asset pricing model kind of converted into the cost kind of side. Okay, I'll get you to read through these. Yeah, read through and read through. It's an interesting area. There's a fair bit written on it. There's also a fair bit on YouTube if you want to go in and do any of these areas in greater detail. Pretty much we've gone through today the bones of it, the standard mathematical approach, and we've also attempted to put some emphasis on the theoretical issues that you need to give some thought to as you're applying these. There is a tendency in finance, especially at this level, when you're looking at managerial finance, which is a pretty exciting area, especially when you see all the things you can do with a little bit of relatively simple mathematics. But the important thing is not to get carried away by the mathematics, whether it's building a DCF model or applying it to things like this sort of financing question. Okay. You need to do a lot more than simply do the mathematics. Mathematics, if you like, is entry level, and that's good. It's important. When you first see it, it can be a bit challenging, but there's a lot more to it as well. And so looking through some of these more practical aspects and so on is pretty important. Okay, I think that just about, well, it does in fact get us to the end of our slide pack. So that's always welcome. Are there any questions anyone might have while we're still here and working together?
Garrick, just wondering if there's...
You go, Natasha.
Sorry, any news on the end of term, what we're doing with the questions?
Oh, I just haven't got onto that. I'll do that after I finish class. Yeah. What was what's the feeling here just in class, by the way? I mean, I know you filled in the assignment, or it's filled in the Survey Monkey, but
I'm happy to get the questions now.
Okay, fine. Any other comments or suggestions there? Yeah, I'll look at that. I should have done that this morning. I was intending to.
I just have a quick question about the date of the exam.
Ah, good question. Okay, and in fact, I've only just got that, and it's only just gone onto the Moodle site. Business Finance will be on Monday, the 19th of October at 9 a.m. And it will run for 3 hours. But because it's a take-home exam, what I'm going to do is make it available for you for a bit longer than the 3 hours you need. It doesn't mean you need to use more of the time, but my plan at present is to probably make it available about 6 a.m. in the morning and collect it. Now, what did I say on Moodle? I better not contradict myself. we go. I'll put that up so we can see. I haven't put. Yeah, the final take-home exam is 9 a.m. Monday, the 19th of October, 12 hours, and it'll be available. Well, it's actually going to be available for more than 12 hours. Is that right? 6 a.m. until 10 p.m. that day. I think it's about 16 hours on that day, but you only need to use 3 hours to complete. That's the important thing. It'll be available for 16 hours, but you'll only need 3 hours to complete it. Now, I'm not going to be putting a stopwatch on you because you're going to be pulling this thing off the internet in your own time. You can, the only way I could put a stopwatch on it, well, I don't really want to do that anyway, would be if everyone had to start it exactly on a particular moment and finish at a particular moment. I don't see any point in that. Some of you have got work. Some of you might find it better to do in the afternoon than the morning. Some of you may not want to take time off your work, and you might want to do it in the evening anyway. So that's why I'm going to run it.
I have a question, sorry.
Yes.
So what will happen if I do more than 3 hours?
I don't know. I mean, I won't have a time clock. I won't have a stopwatch on you. So you could use all 10 hours if you want. I won't see the difference. All I'll see is a file submitted. So by all means, you may use 6-10 hours on it if you want. That could be useful for some students that might, not be able to do assignments as fast as others. But on the other hand, though, if you're the average student, I would recommend not using excessive amount of time because if you only need to write, I don't know, a page, for instance, for a question, if you write 10 pages, well, in most cases, that 10 pages won't say very much more because I'm expecting a one-page answer. I'm expecting a set of issues or points to be raised in that one page. If you give me an answer which is 10 pages long and you're still making, I don't know, the same number of points, even though you spent half a page on each one of the points rather than, a sentence or two, you won't get any different marks. Right. So that's the thing to be concerned about. Often students come back, and I've experienced this myself when I was an undergraduate. You get a take-home paper and you go, oh, this is fabulous, take-home paper, don't have all the stress and all the rest of it. The two mistakes that you make, one is that often I can remember doing take-home exams that were sort of given over the weekend. Oh, mate, those things were a dog. The paper would arrive on Friday afternoon, you had to submit it on Sunday evening or something. That was the end of your weekend. It was horrible, right? Because you just sweat and worry and write and all the rest of it. You might sort of end up putting in, I don't know, 15 hours of work for a 3-hour project. Doesn't make that much difference to your grade. Sometimes doesn't make any. It can conceivably even make a negative effect. So that's one of the big problems with doing, like the strategy problems with doing take-home exams. This sort of tendency to put too many hours into them. The other question, this is really the big question, a big problem with doing take-home exams. You guys, I mean, you've had this experience now from first term, so you probably maybe experienced it. Some of you might have done it yourself, right? There is a tendency to think, oh, take-home exam. I'm going to see all the questions. I'm going to have my textbook next to me. I'm going to have Moodle. And why bother about doing all my preparation and reading and all the rest of it? And I've got a busy life and I've got this and I've got that. And you say, well, since it's a take-home exam, I'm going to have all my resources laid out in front of me. I won't have to do very much exam prep. And so you're kind of expecting that in the 10 hours that we give you to do this paper, you're going to do, in some of cases, your entire term revision in the 10 hours, including writing the paper. You get where I'm coming from? Right. Now, that is a sure recipe for failure. One way or another, take-home exams are like regular formal exams. They ask you for the stuff that you know, And if you're relying on ducking here, ducking there to go and get that stuff, either, reading through the textbook hurriedly or going over Moodle or getting Mr. Google to help you with it or whatever it is, if that's what you're relying, it will take you a long time. You won't do a very good job. And you certainly won't remember much of it sort of off into the rest of your professional careers. I am very, I consider it very, very important that what we're doing with this is stuff which is meant to equip you better for your future careers. And so I want you guys to come away from here with stuff in your head that you're able to apply in 1 year, 5 years, 10 years, 20 years time, right? And you don't do that if you don't do the preparation beforehand. So really, really important. I know some of you have got really busy, demanding jobs, and some of you have found it hard to keep up with the classes. But don't leave it to the last moment just because you've got a take-home exam. It won't help your results. People can fail take-home exams just the way they can fail others. And the best way to fail is to not do the prep work before you go in. Okay. Any other questions?
Yeah, I have. Sorry. So we just need to have 1 page answer, right?
Well, you need to just think to yourself how much work you would do in that amount of time in a formal exam, right? So let's imagine, in this paper, you're going to have 3 hours to do 6 questions. Well, let's work on the 6-question kind of model. That's about half an hour a question. So you just work out yourself how much you can write comfortably in half an hour. And you think, oh, half an hour is a long time. I'll be able to write heaps and heaps, thousands of words. Well, maybe you can. For me, half an hour probably only works out to be a few hundred words. And you can practice that yourself, right? So I'm not going to say it's a page or half a page or 2 pages. Just, practice yourself. Once we give you questions, and now already you can look at the past papers to get, actually the past papers aren't so good for this. Yeah, because this is going to be, look at the theory questions in the past papers, I guess. You'll find that, past paper, the structure was that it had theory and numbers and mathematical questions. Here we're not doing the mathematical questions, and the theory questions are a bit more substantial. But what can you write about weighted average cost of capital in half an hour? What can you write about the purpose of the firm in half an hour? That's the kind of way to approach it. Now, I will, once we're finished here, I might just go off and have a cup of coffee or something, but I'll be very shortly getting down to coming back. I'll look at the Survey Monkey. If we've got, as I say, a clear majority of people that are expressing interest in having the questions available beforehand, then we'll release those to you. And as I said, I was expecting to have them out today. I just didn't do them this morning, so a bit of a busy morning. Okay. Any other questions, or we finish up?
So it's half an hour or 3 hours?
It's a 3-hour paper, and if we assume 6 questions to be done in 3 hours, that means half an hour per question. And if we're trying to work out how many pages or how much text to write, then what I'm suggesting to you is that you work out how much you can write in half an hour and make sure that your answer fits into that space, because otherwise you're just not going to be able to answer all the questions.
Okay, thank you.
Great. Okay.
Okay. For Garrett.
Yes, sir.
Just about the referencing on the exam, because we've got, I don't know, the opportunity to do that because we're at home. Is that something you're looking for in the exam or not really?
Oh, mate.
Not.
I am personally very fond of EndNote. And if you're using EndNote, referencing is a piece of cake. You can get the EndNote program free, download through the library, I think, or maybe Tuseday have taken it over. I would almost say if you're mad if you don't get yourself a download and install EndNote in your computer, because basically once you get it from the university, you can have it forever. And it's just fabulously useful program. Why do I mention that? Because once you've got that, you don't have to fuss and bother writing out Smith J 2014 title, publisher, place, or volumes and folios and whatever it is in the citation, which is fiddly, right? EndNote just flicks it out for you. So between now and the exam, if you haven't loaded up before, I recommend that you explore that. You definitely can download the program. And so the library used to make it available. But it's somewhere rattling around the university. TASAC, the ITD help people, they should be able to help you with that. If you choose to install EndNote in your computer, good on you. You'll find it really useful for all of your subjects, because what you basically do, EndNote is like a bibliographical database where everything that you read that you think might relate to your studies, you basically just put it in this database. And the database basically has a page for each item. And that kind of gives you like a library catalogue. And in EndNote, there's a
No worries.
Yep.
Yep. Thanks, mate.
Okay, fair enough. Well, if you don't have EndNote, this is the second part of the story. I'm really not that concerned about detailed referencing. Okay. In an exam, I understand that you've got limited time, and if you're going to be spending 20 minutes just kind of typing out all the bibliographical stuff, as long as you put enough to generally identify your author, that'll be taken into account. Okay. So EndNote, if you got it. If you don't have EndNote, then whatever you think you can fit in the time.
Yeah, thanks. It's just a bit of a time-consuming thing without EndNote, I guess, the way I do it. So I'll tune up on those skills, and yeah, that's great. Thanks, Garrick.
Yep. Okay. No, I started with EndNote when I was last an undergraduate. I went back and did a second undergraduate degree in the early 90s, and EndNote just saved me a bag of time, and I've been using it ever since.
Sorry. So do we need to do the reference?
Yeah, for EndNote lessons.
In test reference and reference list, do we need to do it?
Oh, so if you don't have EndNote, I'm not looking for the kind of referencing, the extensive referencing that you would get in, say, an essay. Because in an essay, writing out your reference list and so on is, a very important part of getting your essay in, and it takes a fair bit of time. In an exam, I'm assuming that's an exam situation. And so, obviously if you, quote some data, for whatever reason, you might want to quote interest rates, and you might have got it from the RBA. Well, just saying that, the interest rates, see the RBA, da-di-da-di-da. I'm not going to ask you in the exam to write out a complete bibliographical citation if you don't have EndNote. And the reason is that it just takes too much of your time, and I'd far prefer to see your ideas rather than, your bookkeeping, if you like, in the exam, right?
So we don't have to do the reference, right?
Well, it would be useful for you. It's always useful in exams to communicate to the marker that you've done extra reading. So if I simply say, I don't know, the interest rate is 3.7% or something, and I kind of go off and write, well, the marker will look at that and say, oh, I wonder where he got 3.7%. Has he made it up? Has he looked at, I don't know, what the Commonwealth Bank is charging? Has he looked at the average interest rates from the RBA? Right, these are the kind of questions, and a marker would like to give you marks. And if the marker is there thinking, has he used the RBA stats? If he does, that's fantastic. He's a really good student. That's worth, recognizing. So if you make the citation, then it helps me to give you a good mark. If you don't make the citation, I think you're either pulling it out of the air or who knows what, right? So some sort of a citation is useful. Certainly if you're borrowing text from somewhere else, like if you're taking a sentence or a phrase or a paragraph from somewhere else, definitely put some sort of a reference on it, because otherwise you might get stung for plagiarism, academic misconduct.
So how about the reference list? Sorry.
Yeah, reference list is the safest. But I guess the moral of the story is write a reference list of some sort, but the amount of detail in that reference list, because it's an exam, I'm not expecting the same standards, right?
I think it's time consuming. So
yeah, title and author would be probably sufficient. Don't worry about place published and maybe even the year. So that would be like the trim entry-level reference list. At least that tells me that your intention is to acknowledge some source, and you haven't, spent unnecessary time in your exam sort of answer doing it. Also, I mean, part of my thinking there is that I'd like you to be thinking in terms of what would work for your future exams too, because you might come back and do another exam in, 12 months' time when hopefully all this corona craziness goes away and we're able to do sort of regular exams again. Well, it's still a good idea for you to include in your exam, especially in the short essay questions, references to the literature, because that tells the marker that here's somebody who's switched on. They haven't simply, read the PowerPoints and, skimmed over the rest of it. They've actually read the Fin Review, or they've gone to the RBA, or they've listened to or read some statement by, I don't know, Shane Oliver or something. And that's what you see as a marker. That's what I want to see. I mean, I want to see evidence that you guys are really switched on and love your work. Like if you love what you're studying, and you guys are here voluntarily, if you're at school, you wake up in the morning, you go to school, and they're going to do history, and they're going to do geography, and they're going to do maths, whether you like it or not, right? And you go there because you have to. You guys are here at university because you want this, because you want it to help you with your career. And if you want it, the things you want, you should have a bit of passion for, right? So the more passion you can show, and that's, in an intellectual pursuit, a way of showing your passion for a subject, your extra interest, is to show that you've read widely on it, or you've thought further about it. And the more you communicate that to the marker, not just in my subject, but in all the subjects, the more you can communicate that to the marker, then the better grade you're going to get. Now, some people come to university just to get grades. It used to be the case that some people went to university just to find husbands and wives. But some people come to university because they want to learn the most they can to help them get the best jobs and the best future and the most comfortable lives. Right? I like that last option as really the reason you're coming to university. And I guess been my experience on both sides, both as a teacher, but also in the days when I was an undergraduate, you get far more enjoyment out of being in a classroom if you love the stuff that you're learning. Now, you might sort of think to yourself, I really want to be, I don't know, some people in the class are going to be property valuers.
Hello everyone, this is a sound working by here, and no need to look at 6 out of 9.
Say again? I'm sorry, just ask that question again or make that comment again.
So it's useful to look at the past exam.
Oh, the only downside with the past exams is that the past exams were written for a regular examination situation. And so, like for this term in this unit, we're not going to have mathematical questions in the final exam. And so if you go to the past exams, they're bristling with mathematics, right? So the past exam aren't that useful. You can still go to the past exams to look at the theory questions, because the theory questions are, you know, the kind of theory that will still be asked. If, when I go and look at how people filled in the SurveyMonkey survey about how you'd like to do the exam, if I find that a clear majority would like to be given the exam questions early, hopefully before you and I go to sleep tonight, you guys will have the exact exam questions that will be in the final exam. So you won't need to go to past exam papers. You simply go to these questions, and you can spend the rest of the term using these exam questions as the foundations for your review. Doesn't mean that you can't review anything else, but it just means that you've got exactly the questions before you that are going to be in the exam. Couldn't be easier. Okay, folks, I think we've probably covered enough of the questions, and I appreciate your attention. I hope you've found the class today useful. The weighted average cost of capital is a useful tool, like the CAPM though. It's not the total answer to everything, so just keep that in mind. Thanks very much for your questions tonight, especially with relation to the exam, and I will get the exam strategy sort of sorted out shortly and get it back to you. So all the best for the rest of your week, and I'll see you next week.
So I have another question.
Okay, last question.
So the answer is from the textbook or the slides. Do I also need to do the citation?
Oh, no, not unless the textbook is clearly making some reference to something else. Okay, if there's a quote in the textbook, I can't think of an example, but that would be the only place where you would maybe put in a citation. No, the slides and textbook, don't cite them.
So do I need to cite the textbook or slide?
No, just that can be your knowledge, right? We'll let you get away with, you know, appropriating that knowledge as your own.
So I don't have to cite the textbook or slide?
No.
Thank you.
Okay. Good on you. Okay, thanks for the questions. I will shut down the recording, and I'll bid you farewell.